This is Horizon's Middle East and Africa, our top stories this morning. High-profile Republicans praise Donald Trump as the RNC passes its halfway point. The former president tells Bloomberg Businessweek of his plans on taxes, tariffs, and the Fed. The IMF downgrades Saudi Arabia's growth projections by the most of any major economy it tracks. Plus, big U.S. banks crush estimates on equity trading revenue. We'll hear from Bank of America CEO Brian Moynihan. And good morning again, everybody. It's just gone 8 a.m. across the Emirates. I'm Joanna Bersechi in Dubai. As ever, we're going to kick off the show with a quick recap of how markets have fared. And, of course, a lot of scrutiny the last 24 hours about what a potential return of Trump to the White House would mean for foreign policy. He gave an exclusive interview to Bloomberg Businessweek. We're going to talk more about that on the show. But namely, tariffs has been a big question, and most notably for some of those Chinese markets, Chinese tech, we're tracking very closely. Today, though, the Asia-Pacific index is up slightly in the green, about 0.1%. S&P futures, you can see dipping slightly as we head into the U.S. session, down about 0.1%. But that did not stop the major from making yet another record high in yesterday's session. This on back, of course, of traders' increased expectations of rate cuts as we get into the end of the year. Speaking of, 10-year yields sitting at 4.16, or about 20 basis points lower in the course of the last week, 65 basis points of rate cuts priced in by the end of this year. And then gold, the reason we've got it up here is another record high also for gold, as again we start thinking about those rate cut expectations into 2024. But the story doesn't stop there. I want to tell you a little bit more about something that's been going on beneath the surface in U.S. equities, and that is the fact that over the last couple of days, what we have seen is a major outperformance in U.S. small caps. So this is a picture for the Russell 2000. You can see just a little uptick towards the end of the chart there. It does demonstrate how much volume has actually gone in to the small cap part of U.S. equities, hitting a two-year high now for the Russell 2000. It does tell you that some of the rally in the U.S. has started to broaden out into small caps. But let's also check in on how markets in Asia are faring. Avril Hong is in our Singapore studio. Avril, what's on your radar today?
Yeah, Jumana, those Asia tech stocks are on my radar. They were already the ones that were underperforming in the region as we saw that rotation into the cyclical stocks. But now we are getting that added pressure from the Bloomberg scoop about China getting that crackdown on chips from the Biden administration potentially. And that's really hitting the stocks such as Tokyo Electron. That is the big drag on the Nikkei that's turned negative now. The TAIEX also in negative territory after Trump's comments on whether the U.S. has a duty to defend Taiwan. That's hitting stocks like TSMC. Amid all this, we're seeing the offshore yuan holding up pretty well. I think still around the 727 level. Jumana.
Great, Avril, thank you for that. Well, just in the last couple of minutes, we've got some breaking news, and I just want to bring it to you. HSBC have named George El-Hidri as the chief executive from September the 2nd. He is currently the CFO. And of course, this is in response to news earlier on in the year that the current CEO, Noel Quinn, is stepping down. There had been several months of discussions about who was going to replace him, but they've gone for an internal candidate. And as we have just found out now, that candidate will be George El-Hidri, who will take on the role as chief executive from September the 2nd. So that is news just crossing now. And in other news, crossing the Bloomberg late last hour, the Biden administration has told allies it is considering using the most severe trade restrictions available if companies continue to give China access to advanced semiconductor technology. Sources say the U.S. is mulling whether to use the Foreign Direct Product Rule, the FDPR, which allows it to impose controls on foreign-made products that use even the tiniest amount of American technology. Such a measure would be used to clamp down on business in China for Japan's Tokyo Electron and the Netherlands' ASML, which make chip-making machinery vital to the industry. ASML results cross later today. We'll have more later in the show, and we'll be talking about the results and, of course, the fact that the company is caught in those geopolitical headwinds. Now, as traders raise their bets on a second Trump presidency, Bloomberg Businessweek spoke exclusively with the Republican candidate at Mar-a-Lago. The interview focused on business and the economy, including Trump's plans on taxes, tariffs, and allowing Fed Chair Jay Powell to serve out his full term. The former president also outlined his close relationship with Saudi Crown Prince Mohammed bin Salman. He blames former President Barack Obama for eroding relationships with the kingdom and promised that the U.S. will always protect the interests of the Middle Eastern nation. Meanwhile, overnight at the RNC, former governor of South Carolina, Nikki Haley, told Republicans that the former U.S. president has her full support.
Donald Trump has my strong endorsement, period.
My return. Let's bring in John Hart, Emeritus faculty member at Australian National University. Good morning to you, John. Thank you so much for joining the show. Look, it appears to be pretty evident at this point that at least the betting markets are assuming it's going to be a done deal that President Trump is going to be returning to the White House. In your view, do you see that as the most likely path? And then also, what sort of probability are you placing on a full red sweep at this point?
Look, I think anyone who tries to predict the outcome of this very topsy-turvy campaign is rather foolish at the moment. Trump is ahead in the opinion polls marginally. He's ahead in the toss-up states marginally. He was, before the assassination attempt, he was ahead slightly before Biden's gaffes in the presidential debate. But there's still 3.5 months to go. This campaign has been one of the strangest election campaigns in American history. And it's not altogether certain at the moment that Joe Biden will be the Democratic candidate. That could change over the next few weeks before the Democratic convention, which meets in Chicago on August the 21st.
So we'll talk about Biden, but let me just ask about something else, because there have been several criminal cases put forward against President Trump, former President Trump. Many of them are now facing significant delays or have even been annulled. For example, yesterday I saw that one of the U.S. districts actually dismissed 40 felony charges against the ex-president for mishandling classified documents. Should we read this as perhaps that many of these issues are just going to be forgotten, and that for those on the other side of the aisle who perhaps that maybe President Trump would be going through a legal process and that he could be brought to justice somehow, those efforts will have gone to nothing, would have mounted to nothing?
One thing Donald Trump has been very successful at is delaying and obfuscating these legal cases that he's faced with in America. Even the New York one where he's been found guilty of business fraud, he's managed to force a delay in the date at which a conviction is going to be determined until September. I think, to cut a long story short, it's now very unlikely that any of these cases will be resolved before the presidential election in October. And if Trump wins the election, some of those cases, particularly the federal case against him regarding the January the 6th invasion of the United States Congress, and the case against him that has just been dismissed in Florida relating to taking government records with him, that will be appealed. But I doubt very much whether they will continue once Trump is president. He will simply get his attorney general to stop the prosecution.
Yeah. Let's turn to the other major appointment over the last 24 hours, and we're just displaying images of that now. His choice of J.D. Vance as his running mate. Many people are saying that he's selected a mini version of himself, and that this is demonstrative of the fact that MAGA ideology has really taken over the Republican Party. What is your stance?
That's right. It's unusual because the traditional thing is for a presidential candidate to select his vice presidential running mate from someone who will bring strength to the ticket where he is weak. And frankly, Vance doesn't bring any particular strengths to the ticket where Trump is weak, because he's now, although he wasn't always, but he's now almost a clone of Donald Trump. I don't think the selection of the vice presidential running mate is going to have much impact on the election campaign this year, because it's a one-man show. The Republican Party is all about Donald Trump. It won't be about J.D. Vance. I think perhaps the biggest reason behind the selection of Vance was that Trump wanted to secure the future of his brand of leadership of the Republican Party, the Make America Great Again movement. And Vance is someone who he can be pretty sure of will do that. Vance, from his point of view, I suspect he sees this as a great opportunity to put himself as a front runner for the presidential nomination in 2028, when Trump obviously wouldn't be the candidate again. If Vance is actually elected vice president, that will strengthen his 2028 position very strongly. The only danger with Vance is that he's got to avoid suffering the fate of so many other politicians who have worked closely with Donald Trump, and that is falling out with Donald Trump for one reason or another and getting on his bad side. And all you have to do is remember what happened to his previous vice president, Mike Pence.
Perhaps one for another conversation, but we'll see how this all evolves. John, a real pleasure to have you on our show, and I'm sure we'll speak to you again closer to the election time as well. John Hart, Emeritus, faculty member at Australian National University. Up next, the IMF cuts its growth forecast for Saudi Arabia as the kingdom remains focused on growing its non-oil economy. We have the details next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jumana Bersachi in Dubai. The International Monetary Fund has downgraded its growth projections for Saudi Arabia by more than any other major economy it tracks. The kingdom's 2024 growth projection has been lowered to 1.7% from 2.6% back in April, reflecting the decision to reduce oil supplies. Joining me now is our Middle East economics reporter, Abir Abu Amar. Abir, let's just talk about this downgrade that has come through. It feels to me that it's somewhat of a mechanical downgrade. The IMF have downgraded their view of oil prices in addition to the production that's coming out of Saudi Arabia, and therefore it follows that they also had to downgrade the GDP forecast as well.
Good morning, Jumana. And you would be right to assume so, right? So this GDP estimate, 1.7 from 2.6 in April and then 4% by the end of 2023, comes entirely from oil production cuts. It is mechanical. We did speak to the IMF right after this report came out yesterday, and they did tell us that, listen, this is an oil production mechanism. The kingdom has slashed their oil production to about 9 million barrels by the end of last year, and this is a cut that is expected to continue into this year. So the IMF is expecting this downgrade in the overall GDP, which perhaps can have an impact on the kingdom's revenues, as we have seen it had by half of the second half of last year. But one thing that the IMF told me yesterday was something that we've been watching and something that continues to be resilient and robust is non-oil growth. So while it eased during the first quarter of this year, non-oil growth continues to be an acceleration, and it continues to be, the sector that the Crown Prince and the Saudi government is focusing on.
Yeah, very clear. Bloomberg's Middle East economics reporter Abir Abu Omar. Let's continue this conversation. I'm going to bring in Aathira Prasad, Macroeconomics Director at Nasser, Saidi and Associates. So let's just bring in the numbers here. IMF are forecasting 1.7% growth in 2024 versus 2.6% in April, 4.7% for next year. How does this square up versus your own estimates?
Well, it was quite expected that there would be a downgrade in the growth forecast for Saudi, mainly so because of the oil production cuts that they have been going on with for some time now. But the main point that you need to keep in mind is that they still have a very robust non-oil sector. Your PMI numbers are still high, new orders are quite high. And so what it means is that going forward, you still have a very robust non-oil sector growth that you're going to get versus maybe a still low oil sector activity. And this again, it falls back on the kind of projects that they have in the pipeline. You have your mega projects and giga projects, and you have the mega events that are coming up, including the Winter Games. You have the Expo 2030 coming up and the FIFA World Cup a bit later on. So all this needs to be built up. So there's a lot of money being spent, both from the government side and also the PIF, which essentially means that there are going to be projects all the way through end of the decade.
You know, it also means as well that they have a huge amount of funding needs. And one of the stories that my colleagues on Bloomberg News put out last week is that because of that, they've had to be a lot more discerning about the types of projects that they're putting money into. This has necessitated spending cuts. If we were to see more of this type of reallocation or just broad level spending cuts, do you think that would necessitate another downgrade to growth?
Not exactly. I mean, we always view this as a positive thing because it means that the Saudi government or the policymakers are paying attention to, say, prioritizing projects that are more important than as opposed to, you know, projects that may or may not give you necessary returns in the long run. So more job creation, more private sector participation is what they are looking for, and that's always a good thing. It also means that they're going to do much better on their fiscal side because what you're essentially talking of is expenditure rationalization, which will benefit them in the long run. And as you have seen in the past few weeks itself, they are looking for alternative funding sources. They have been tapping the debt markets. You've had the Aramco secondary sale and so on. So the funding is coming in, and it's not going through the banks, which is always a good thing because you do not want to unnecessarily burden the financial sector in the country. So all in all, I believe that non-oil sector will drive Saudi growth, at least in the foreseeable few years.
You mentioned something interesting there when it comes to PIF, because it's not just the government that's going down this funding route. You also have the other various state-owned entities that have been borrowing as well. At what point should we start to worry perhaps about contingent liabilities?
Interestingly enough, most of these sovereign wealth funds in the region have had a negative connotation in the sense that they're not very transparent in their dealings. But this has been changing over the past few years. I mean, they're more open to, opening their accounts books, telling you what assets they've put funding in, and so on. So it's still maybe not as transparent as you see, say, for example, in Norway, what you see in Norway, but it's still getting there, which means that there is a little more transparency into the dealings that they have. So you know what kind of assets they have backed and what are the benefits that are getting accrued to them. So it's still a more transparent framework than what it used to be before. So in all, it should be reasonably okay in terms of funding.
Final question. What does slightly slower economic growth for Saudi Arabia mean for the rest of the region?
Saudi is one of the major economies in the region. There would be some some impact in terms of the project pipelines and people getting employed, which means that remittances could be affected. But there is a strong FDI inflow as well, which means that there is still money coming into the market, projects are going on track, and so on. So there might be an overall slowdown in the overall MENA or GCC growth rates, but it shouldn't be that impactful in the near term.
Yeah. Very clear. Aathira, thank you so much for coming on our show today. A pleasure to chat to you. Aathira Prasad, Macroeconomics Director at Nasser, Saidi and Associates. Thank you. Also coming up, Wall Street equities trading has boomed, boosting profits. We get all the details next. This is Bloomberg. Wall Street's biggest banks saw an 18% jump in combined second quarter revenue from helping clients bet on stocks, crushing analyst estimates. Morgan Stanley's equity trading unit brought in over $3 billion, second only to Goldman Sachs. Meanwhile, Bank of America's haul was just under $2 billion. Let's bring in Matt Ingram from Bloomberg Intelligence. Matt, Bank of America, Morgan Stanley rounded out the big U.S. bank reports yesterday. What stood out to you?
Yeah, g'day, Jemana. Look, it was the same story really as the other big banks. It was all about investment banking and it was all about trading. Equities, debt and M&A were very strong. Equity trading was also strong, but perhaps Bank of America a bit of a surprise. Their fixed income trading was weak, but generally speaking, those are the standouts. Also costs, we're expecting Bank of America might have a bit of an issue with regulatory expenses, but their cost ratios were very healthy and we think this might follow through for the remainder of the year, I guess along with a lot of their peers.
Yeah, it looks like equity trading has been really strong for the Wall Street. Even investment banking fees are up. But what are the signals that we were getting on net interest income?
Look, it's surprisingly positive. It was a really weak quarter for margins and net interest income, but JP Morgan said they thought things were stabilising. Bank of America said this quarter will be the trough. And the common theme is deposit pricing. That's going to ease off and that's going to feed through to margins. So actually net interest income might be a bit of a tailwind in the second half, where it was definitely a weak point this quarter.
Yeah. Matt Ingram from Bloomberg Intelligence, thank you so much for the report on the latest. Well, we're going to continue on the show talking about all of the political news that we've got over the last 24 hours. The Republican presidential nominee Donald Trump sounds ready to radically alter the terms of the U.S.-Taiwan relationship. So we will be talking about that. But before that, a quick look at markets. So this is how futures are faring. S&P futures dipping somewhat after another record high yesterday. Nasdaq 100 also slipping a little bit. The Dow, which was the massive outperformer in yesterday's session, seen opening up in the green. And then Eurostock futures seen opening up slightly positive as well. We're going to talk more about markets and U.S. politics in a moment. This is Bloomberg. This is Horizons Middle East and Africa, our top stories this morning. High-profile Republicans praise Donald Trump as the RNC passes its halfway point. The former president tells Bloomberg Businessweek of his plans on taxes, tariffs, and the Fed. The IMF downgrades Saudi Arabia's growth projections by the most of any major economy it tracks. Plus, big U.S. banks crush estimates on equity trading revenue. We will hear from Bank of America CEO Brian Moynihan. Well, it's just gone 8:30 a.m. across the Emirates. I'm Jemana Versace in Dubai, getting you up to speed on some of these major market moves. A very strong session once again for Wall Street yesterday. A strong performance in the Dow. And what we're beginning to see, as we talked about earlier on in the show, is a rotation out of some of those mega caps into small caps. A very strong performance by the Russell 2000. Today, you can see that the S&P futures are leaning slightly towards negative, but again, coming off another record high. Asia-Pacific markets up about 0.1%. This as over there, we start to focus more on the geopolitical consequences of a potential return of Trump to the White House, and of course, the fact that he has touted tariffs as another tool. So again, that could be quite a blunt tool and could have a big impact on the Chinese economy, a big theme for investors over there. 10-year yields sitting at 4.16. Investors again pricing in further possibility of rate cuts this year. 65 basis points now priced in between now and the end of the year. September pretty much fully priced at this point. And then gold just coming off a record high, so about 7 basis points higher today. But it is not just equities that have reached record highs, the gold sector as well. So gold bullion at a record high. But another stock that we're watching this morning, the shares of HSBC in Hong Kong after the market returns from their lunchtime break at the top of the next hour. The bank has named the CFO, Georges El-Hedri, as its next CEO, continuing the bank's tradition of picking insiders to run the bank. He'll take over from Noel Quinn on September the 2nd, who is retiring after 30 years with HSBC, including 5 as CEO. So currently shares are on their lunch break in Hong Kong trading, but will be returning shortly. You can see slightly up. It was trading slightly up in the green, about 0.1%, but for the year tracking just south of double digits. Now let's check in with Avril on some of the other stocks in focus in Asia. Avril.
Yeah, Jumana, we're seeing the chip stocks getting hard hit today. The likes of TSMC already were the drags on the Asia stock benchmark in the early part of the session after Trump's comments on Taiwan. But we also got that Bloomberg scoop about how the Biden administration is mulling those tighter trade restrictions on its allies, all as part of efforts to restrict China's access to chips. And Tokyo Electron is reaching those session lows, actually coming off a bit, but still extending those declines after that story dropped 7.5% down. But let's flip the board and take a look at what we're seeing in the Chinese currency. As you mentioned earlier, tariffs being floated. These are, part of really blunt tools. And amid all this, the Chinese currency has been holding up pretty well, all things considered. So maybe some of the peak pessimism has already been worked into the markets, especially given the third plenum that is underway this week, Jumana.
Yes, indeed. So much is going on. We haven't even talked about the plenum yet. Avril, thank you so much for the overview of some of those Asian markets. Well, more now on Bloomberg Businessweek's exclusive interview with Donald Trump and what could be a dramatic shift in foreign policy. The Republican presidential nominee has questioned the U.S. commitment to defending Taiwan, saying the island should pay for protection. Bloomberg's Nancy Cook told us more about what Trump said during that conversation.
We ended up asking, a lot of economic questions about sanctions against Russia, and we asked about Taiwan sort of as a throwaway question. And he basically came out and said, what has Taiwan done for us? We have been Taiwan's insurance policy for years. They stole our chips business. I'm just not sure it makes sense for us to, keep defending them when China wants them so badly. It was a really remarkable moment.
Well, for more on this, let's bring in Bloomberg's news desk editor, Jill Desis. Always good to chat to you, and plenty to unpack from that conversation with Trump. I would highly recommend to viewers to spend about 20 minutes reading through the full interview. Maybe let's just start with those comments about Taiwan, because they do suggest a major shift in U.S. policy.
Yes, Jumana. I think Nancy put it pretty well there, this idea that it's kind of grounded in economic resentment, what Trump's getting at here. He's saying, they're an incredibly wealthy economy. The idea of stealing chips away from the U.S. manufacturers or some such. But yes, it's really more grounded in this idea that the U.S. has, this military operation that's kind of committed to defending Taiwan, obviously, in the event of some kind of a China invasion. China, of course, thinks that Taiwan should be part of its own territory. And he's saying that, they should kind of pay up for that if that's the kind of protection that the U.S. is affording Taiwan. This is actually, Jomana, something that we've seen Trump kind of echo in other comments about some of the U.S.'s other allies. You're looking at NATO, for example, a lot of, European allies, and what Trump has kind of said about this idea of, the U.S. being out there and kind of, protecting others, whether the U.S. should be compensated for that. You've also seen that with regard to the way that he's explained the U.S.'s relationship with South Korea, having military presence in South Korea, trying to protect, the event of, North Korea aggression or something like that. So this is something that he's kind of broadened out, it seems, to incorporate Taiwan, which obviously is an enormous geopolitical flashpoint at this point in time.
Yeah, yeah. And also just interesting because of, the many things he said about China over the last couple of years. It's surprising that he would then take the stance vis-a-vis Taiwan. Speaking of China, we know that President Trump is a fan of tariffs. He's floated this idea of up to 60% tariffs on Chinese goods, but 10% tariffs on goods from the rest of the world. What more did we learn from that interview?
Yes, well, Jumana, I think, in order to try to rectify a lot of Trump's maybe on the surface seemingly conflicting views about China, what you ultimately have to remember here is that this is a presidential candidate and former president who just overall has incredibly protectionist policies and mindsets about a lot of things when it comes to the United States. So, yes, this tariff, sort of these tariffs that he's floating in this interview really kind of, accompany that. So, yes, 60% new tariffs on China, along with a broad-based 10% tariff on all other foreign goods coming into the U.S. And so what he's ultimately trying to get across here is this idea, again, these ideas of these deep economic grievances that he has with the U.S. As it relates to other economies. This is certainly a big part of that, is this idea of some kind of a blanket tariff announcement. And so you really see a lot of that protectionist mindset come into play here. I think the other thing with China as well is that, the Trump camp would point to the Biden administration not removing any of Trump's previous tariffs on China as kind of validation for some of their efforts there. And it seems that that's kind of emboldened Trump to think a lot of the ways that he does now about further duties on goods from China and from elsewhere. You really have, that kind of, again, that idea of those protectionist policies here.
Yeah, it takes me back to 2017 when that was all we were talking about. I guess it's going to be the same potentially next year. Bloomberg's news desk editor, Jill Desus, thank you. Let's bring in our next guest. Altaf Kassam is Managing Director and EMEA Head of Investment Strategy and Research at State Street Global Advisors. Very good to speak to you, Altaf.
Good morning.
Speaking to Jill there about the possibility of the return of these tariffs or tariff discussions or tariff threats, I can't help but think with the S&P making a new record high every single day that perhaps investors are being too complacent about some of this political risk next year.
Yeah, thank you for having me. We do think that the geopolitical risks which are out there aren't being adequately priced by the market. And we've been talking to clients about using this as an opportunity to hedge. And as you pointed out, and as we have in our tactical portfolio, we've been adding to gold as a bit of a geopolitical hedge as well. So we don't think the risks are adequately priced, and we think volatility is cheap right now, and we are looking to add protection to our portfolios.
Yeah. And, I think the other development over the last couple of days is certainly there is a lot of momentum behind former President Trump. Betting markets are putting his probability of winning the elections at around 70%. And so, that seems to be the baseline scenario now. But do you think, again, market participants are adequately pricing in the possibility of a red wave, so a full Republican sweep?
Where I think it would be most clearly shown is in the steepening of the US yield curve, and that hasn't happened to the extent that we expect. We do think if we have a Republican sweep, Trump's policies, as they've been quoted, are basically inflationary with tariffs, as you've pointed out. And so we'll see the short end come down, the long end come up as we anticipate higher inflation in the future. And that hasn't been fully reflected. We have seen some steepening in the US yield curve, but not to the extent that we'd expect. Apart from that, the problem with Trump's policies is they tend to be quite volatile. He says one thing, he does another. As you've heard as well, he uses tariffs as a negotiation tool, so he'll talk big, but then might scale them back. So it's hard for the market to accurately price what a Trump presidency and a Republican sweep might mean, but we would expect to see the first signs in a steepening of the yield curve, which has started, but has not gone to the extent that we would expect.
Yeah, I mean, 230s is still basically trading around zero, so the curve is flat. There's plenty of room for it to steepen. Let me ask you about another phenomenon that's been taking place the last couple of days, and that is the fact that we are beginning to see finally a bit of rotation away from mega cap stocks into small caps. Russell 2000 now sitting at a 2-year high. Do you expect that type of rotation to continue? Does it have legs? And what do you point it down to?
Yeah, I mean, the rotation basically started when we had that really moderate CPI print in the US, and we saw small caps go up that day over 3.5%. And that's really the story. The story is that small caps and smaller stocks, weaker credits, are more exposed to the higher for longer interest rate environment. They haven't been able to refinance at the lower rate that larger companies have been able to. So the longer that rates stay higher, the more they start to hurt and the more worry that things will crack. With this weaker CPI prints, the feeling was that, okay, this really gives the Fed the signal to cut rates, and that was going to be disproportionately beneficial to the smaller companies, smaller caps, weaker credits. If that story continues, if we hear more dovish rhetoric from Powell and his colleagues on the Fed, if we see weaker data coming out of the US, then that rally should continue, that rotation could continue as well. But it's really dependent, as ever, on the data.
Yeah. Let me turn your attention to China. There's so many different signals coming out of China now. The path for Chinese equities, obviously, we're in the middle of the plenum this week, and we know that the authorities have this focus on high-tech growth. And yet there has been, as flagged by my colleague David Inglis yesterday, somewhat of a wedge emerging between what's happening with U.S. tech and Chinese tech. Equally, you hear more and more signs of consumer softness. You know, some of the luxury companies in Europe are reporting that their sales to China are down more than 30%. So how do you square up the weakness that's coming through with the authorities' desire to, keep pushing the economy and focusing on the high-tech parts of the economy? And then how does that actually translate to Chinese equity performance?
Yeah, I think what we've seen is that the Chinese story, say, post-zero COVID, was that they were going to focus on their own domestic consumer. They were going to move from being export-oriented, all about manufacturing, to more domestically oriented, more consumer-focused. And that really hasn't happened because the Chinese consumer is so worried about the property market, where they have a lot of, quote, savings stored up, that they haven't been able to go out and spend with the kind of conviction that's necessary. So China's then pivoted back to its old model, which is manufacturing-oriented, export-driven, really gone for those transition energy sectors, batteries, electric vehicles, solar panels. And now, as you say, I think it's going to continue that, but with a focus additionally on kind of new technologies, artificial intelligence, and also quantum computing. That's going to happen behind closed doors. I don't think we're going to hear a lot about it, but it's going to happen because it's seen as strategically important. So we're seeing China flip-flop between saying it wants to open up, look at its consumer, talk about common prosperity, to going back to its old model of exports. And so we're going to see more pressure, especially with the potential Trump administration, on those key sectors which China is looking to dominate in terms of exports.
Yeah, we did a big read on that yesterday, the big take on Bloomberg, and they were talking about the fact that these high-tech sectors will have to compensate for the pullback in the real estate sectors. So the work is cut out for them. Altaf, Kassam, thank you so much for joining us on the show, for waking up early for us. Managing Director and EMEA Head of Investment Strategy and Research at State Street Global Advisors. Also coming up, Uganda is entering talks with the IMF for a fresh loan as the country's $1 billion credit facility comes to an end. More on this story next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jumana Bersachi in Dubai. Authorities in Uganda are negotiating with the IMF on a new loan package to replace the $1 billion credit facility that ends soon. Uganda finds itself in need of other funding sources after the World Bank froze new lending after the nation passed harsh anti-LGBTQ laws. Let's bring in our Africa correspondent, Jennifer Zabazaja, who joins us from Johannesburg. Maybe let's just start with the negotiations with the IMF. Obviously, we know that this facility was put in place a couple of years ago, back in the times of COVID. They're coming to the end of it. Where do they stand vis-a-vis negotiations over what happens next?
Right, Jumana. I mean, the main point that we've been focusing on is that they are happening, and that's significant for a few reasons. I mean, you mentioned that 2021 program is wrapping up. We actually just saw Uganda get their 5th disbursement earlier this year. They're awaiting the 6th disbursement. But what's key to what has happened in the time since they actually got this program initiated is that they have this anti-LGBT bill that has really had a significant impact on the country and their funding sources. And in particular, they had the World Bank freeze loans to the country, and that has created more pain to their budget deficit in the country. And so the fact that they are even having negotiations, potential discussions with the IMF is significant. The question, though, is what potentially is the IMF going to ask for? Because they have, in their own right, expressed their own concerns about this bill that Uganda passed last year. And so we'll have to see whether or not they will actually get another program kicked off with the fund.
Jen, what is at stake if they don't get another tranche or they don't get to an agreement with the IMF? What is at stake for the economy here in terms of the economic outlook and the finances that you just mentioned?
Right. It's quite concerning. And I mentioned what the IMF has said. We actually saw that the country expects their budget deficit to widen to 5.7% of GDP from 4.5% in 2023. Not just that. I mentioned the funding gap that they have. They're also anticipating a slowdown in recovery, potentially some setbacks to any sort of recovery that they have had since the COVID pandemic. And that is not even factoring in the other shocks that they're facing, weather-related shocks, of course, fuel price gains from the Middle East conflict, and also exchange rate depreciation. So the shilling has suffered a number of a significant depreciation since this bill was passed, despite the central bank trying to raise interest rates. And so the country is really in need of some funding sources. But as I mentioned, they may have to make some concessions and actually step in and potentially review this bill that they have passed, because it's seeming like their international funding sources are very concerned about what this could potentially mean.
Yeah. Jen, thank you so much, as ever, Jennifer Zabasaja. Now for a look at some of the other stories we're following today. The hearing of a Binance executive in Nigeria has been adjourned to October. Tax evasion charges against Tigran Gambarayan have been dropped, but he is standing trial on other charges, including currency manipulation and money laundering. The head of financial crime compliance at Binance was detained in February during a visit to the country. U.S. lawmakers say he is held unjustly and are pushing for his release. Also coming up, the world's largest supplier of top-end chip-making machinery, ASML, reports earnings in the next hour. More on what to expect next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jumana Bersechi in Dubai. Europe's biggest tech firm, ASML, is set to report its second quarter earnings in the next hour. The world's sole supplier of top-end chip-making machinery is expected to show improvement quarter on quarter. Its top customers include TSMC, Samsung, and Intel. Order bookings might have surpassed 4 billion euros on strong monthly sales for its foundry customers. So for more on this, Bloomberg's Daybreak Europe anchor Tom McKenzie joins me now from London. First of all, Tom, just set the scene for us. What can we expect from these results?
Okay, this is why we're really excited about ASML. As you said, the biggest tech company in Europe. But what it tells us is a story about demand for AI chips, because this is a company that provides that crucial component within the ecosystem of churning out these AI chips, which are these extreme ultraviolet lithography machines, essentially machines that have these lasers that etch these patterns and chips onto the silicon. These are absolutely essential. ASML dominates. No other company in the world makes these high-end machines that TSMC, Intel, and Samsung, as you demonstrated earlier, need to turn out and churn out the most high-end chips. The other interesting part of the story is the demand coming out of China, not for the high-end, because those are now restricted, but for the older generation chips that go into things like EVs. As you said, there's a number of analysts out there looking not just for the guidance, not just for the China story and the AI component, but as well what it tells us leading into 2025. Because ASML have said this year, 2024, is a transition year for them. They expect essentially flat growth, but it's looking ahead to 2025 where they see a pickup in growth. So any signals on that is also going to be in focus. Jefferies looking for sales numbers, booking orders coming in at around 5.5 billion euros.
Yeah, well, Tom, you said the word restrictions there, and a story that just came out in the last hour from Bloomberg is that the Biden administration is floating tougher trade rules in this latest chip crackdown on China. ASML is one of the companies that could be directly impacted. How much of an impact is it likely to have?
Yeah, so ASML sits on this dividing line. It is central in terms of the tensions between the US and China, and the US has made these overtures to The Hague, to the Netherlands, to say, look, you need to lean on ASML to restrict their shipments of these machines into the Chinese market, and to some success up until this point. But the US is still concerned that engineers from ASML can get onto the ground and keep servicing the machines that are already there. So they are now threatening, it seems, according to Bloomberg reporting, to use additional leverage to restrict the ability of these engineers to get on the ground and do that kind of work. So we'll see how that comes to pass, but certainly it is a further warning and a further shot across the bows for ASML that got, in the first quarter of this year, about half of its sales came through from China. Chinese companies are pushing through in terms of that demand for these machines. They want to pull them in because they are cognizant of the fact that restrictions could get ever tighter. Again, this isn't for the highest end, most sophisticated lithography machines. It's for the older generation ones that they need for things like EVs and smartphones. So we'll see to what extent the Chinese demand plays into that. But again, going forward, the reporting from today, just a reminder that the ASML story and ASML as a company sits on that dividing line.
Yeah, and you've just got to wonder how that story is going to emerge as well, with a potential return of President Trump to the White House. Bloomberg's Daybreak Europe anchor Tom McKenzie, and of course Tom's show is coming up next. This was Horizons Middle East and Africa. I'm Jumana Bersachi in Dubai.